Hi, I'm Matt McAleer, Executive Vice President and Director of Equity Strategies, joined by John Mousseau, President, CEO, and Director of Fixed Income at Cumberland Advisors in Sarasota, Florida. Today, we will be discussing our thoughts on the first half of 2022 with a real specific focus on Q2 and how the action in both the equity and fixed income markets affected the Cumberland strategies over this period. In terms of what we'll be covering, John will be looking at fixed income. I will be looking at equity. John, what were some of your thoughts in the broad fixed income markets before we get into the specific strategies?
Yeah, thanks, Matt. Really, this past quarter and year in general has seen the bond market spooked. What have the bond markets been spooked by? Well, when you think about the bond markets, most of the time, they're fairly docile. Think about a horse tethered to a post. Most of the time, it's walking around not bothered. But when something spooks the horse, it pulls the post right out of the ground and starts bucking. And that's been the bond market this year. It's been spooked by inflation. Did we have inflation last year? Yes. But the market sentiment was that it was going to be transitory, like the Fed told us, and would come back down. It clearly has not. That has spooked the markets. The second thing that has spooked the markets has been the Federal Reserve. The Federal Reserve started to raise short-term interest rates in March. They have continued to do so with a 75 basis point push last month, probably push up rates another 75 basis point this month. And with the inflation numbers still not coming down, the bond markets have been spooked by the fact that, boy, the Fed's going to keep going. So both of those things have really had the bond markets jumping in rates this year. Think about the 10-year Treasury bond doubling from 1.5 to 3. Bond fund liquidations in munis. But the real point of it is that this happened as a rebound off of COVID, and it is something that is not normal in a normal bond market cycle, and we're treating it as such.
Good. In terms of equity overview, it's been tough in nearly every style and every sector and industry. Tough place to hide. Even the one area that hung in there for quite a while, energy, really took their lump. That sector was down 25% in June alone. So markets are really reacting to rates, reacting to inflation, trying to get it. It's an overused comment or quote, but trying to get it pricing in that worst case scenario. So in terms of those markets, let's take a look at how did those markets affect how we manage money in our strategies. On the equity side, we manage strategies in 3 different styles: a core style, a quantitative style, and a thematic style. I'm going to cover each of those styles separately. John's going to cover on the fixed income side our tax-free muni strategy and our taxable fixed income strategy. So if we get started here, let's look at our core strategies first. How did they make out in the first half and specifically Q2? Well, in terms of our U.S. Core ETF strategy, good news and bad news. Good news, it's ahead of its benchmark. Bad news, benchmark's down, and so is U.S. ETF core strategy. We are tilted value versus growth, so that was somewhat helpful. Where we really got punished in that core strategy was a small cap tilt towards growth, and we did sell that during Q2 and are currently sitting on close to 20% cash. So that's a core holding. We're watching analytics closely to see when we can get that cash back at reasonable levels. Our second strategy that I'll cover before shooting over to John is our international strategy. As tough as the domestic markets were, the international markets were even worse. There is nowhere to hide. Developed and emerging markets down identical, down about 20%. Very unusual. And what that tells you, it was pure selling, pure liquidation. There was no pare back on developed specifically say Europe, Canada, larger economies, and go tilt towards emerging or vice versa. It was pure liquidation.
Piling on.
That's really what it was. Asia, slightly better than Europe, but in terms of trying to find areas for your capital that were safe, very tricky to do. We're about 8 to 10% cash there right now. Our most recent position has been an international energy position. That seems to be trading well. As I mentioned, energy traded down pretty severely. So we're seeing through the beginning of July a little better trading activity internationally, as we are domestically. We'll see if that holds up. And then finally, our active passive strategy we consider a core strategy. In that strategy, 60% equity, 40% fixed income. The 60% equity is divided 2/3 S&P 500, 1/3 mid-cap 400, and then paired with fixed income. And when that 60-40 gets out of line by any more than 5% on either class, either asset class, we rebalance. So it's a tried and true foundation type of account. And in terms of Q2, a little better tone towards the end of June, starting to see some higher lows in mid-cap. That suggests some of that severe selling may be drying up. So in covering those three core strategies, why don't we jump over to your two primary fixed income strategies?
Sure thing. We'll cover the taxable bond strategies first, but it's important to remember that we manage money here at Cumberland in our total return strategies in a barbell method, which means that we have money at the shorter end of the yield curve and some money out of the longer end of the yield curve. Doesn't mean we always have it that way. When the Fed is in a rate hiking cycle like it is now, when it gets towards the end, we'll move some of that barbell towards the middle of the curve. But in general, that's where we've been. If you think about this year, and it is a tough year, it has been the worst year in bonds in over 50 years, and in some cases worse than that. So you really don't have something to look back on in recent history and say, oh, this is what it was like, because it was unlike anything we've seen.
Right.
However, if you look at the level of interest rates, we are pretty much where we are. Think about 3% on a 10-year bond where we were in 2018 when the Fed had started to hike rates back then before calming down at the end of the year. What has spooked the markets is not where we are, but how fast we got here.
Right.
Started the year at 150 on the long bond, and now we're at 3%. We peaked at around 345 or so, earlier in June. So when we look at this, we say, okay, what do we do? Well, we've extended our durations, extended our maturities, bought longer bonds, bought longer spread product. Think about something like a taxable municipal bond, which probably at the beginning of the year was yielding somewhere around 3% and change, is now 5.25. That is some very good core yield. And is it core yield looking good compared to a 9% running inflation rate? Of course not. But our viewpoint is that inflation, which is a lagging indicator, will probably come down as you go over the second half of the year. And indeed, we're seeing anecdotal signs of that right now on anything from commodity prices to housing prices, which have started to see some give, to other economic indicators and sentiment indicators. So in our view, it isn't a question of if inflation comes down, it's just how it starts and how fast it does come back. So we feel pretty confident in moving some of the longer paper into this, now what we consider very attractive range.
And John, for somebody like myself that works within an earshot of you, I understand that positioning day to day. But tell me if I'm hitting it correctly. When you look longer term, if you're buying 4s, 4.25s, 4.5s when bonds were really being sold tax-free,
right,
at an inflation rate of 7 or 8, that may not look great today. But a year from now, if we're at a 5, a year and a half from now, if we're at an inflation run rate of 3.25, and you have bought bonds in that 4.25 rate, that's a very attractive spread.
That is very true. And on the tax-free side, we're doing the same thing. The tax-free market actually got hurt worse, believe it or not, than the taxable market. Think about a long municipal bond at the end of the year was trading around 2, and that was cheap. I'm talking about a 30-year bond, and now that 30-year bond is 4.25. It got as high almost as 4.5. That is very attractive when you start to compute taxable equivalent yields. In other words, what you would have to earn in the taxable marketplace to earn the same as you're getting on a tax-free bond. Depending on what state people are in, that number can range anywhere from 6.75 to well over 8. So we think those are very attractive returns right now. What caused the muni back up? Same kind of spooking of the markets, except the way it gets reflected is in bond fund liquidations. They started slowly, started to build up, and then suddenly bond funds were getting liquidated at the tune of $5 to $6 billion a week. And what happens is that kind of selling feeds on itself. The dealer community gets overwhelmed, the bids drop, repeat the process the next day, and this is how the market spikes up in yield and down in price. Now you're at the point where we're actually seeing some inflows into bonds, and that is in bond funds. That is what you would expect when rates go from 2 to 4.5. Right. Someone's going to say, I'm done selling. What the heck? I'll start buying. You're starting to see some of that now. And so we have been locking in some of these high 4% plus tax-free yields because we haven't seen them except very briefly during the COVID sell-off. And before that, you really have to go back to 2016 to see them. So we think it's just a real gift to be able to add these to portfolios. And Matt's right. Our viewpoint is that we're looking out at inflation and a run rate out 4 years, 5 years, et cetera. And if you look at the market-derived estimations on those inflations, the market thinks that inflation is going to be, something under 3. Not going to be 2, but maybe 3 is the new 2.
Thanks, John. Great wrap up. We'll see what Q3 brings us in bond land. Let's jump back over to equity and cover our quantitative strategies. The quant strategies had buy signals in January, late January, and February. Those signals, John, are still intact.
Right.
So we are long in the quant strategies since those signals. Remember with our quant strategies, specifically market vol and leverage market vol, if we get a buy signal, we are all in 100% the S&P 500.
Right.
If we have an exit signal, we're in cash. So when I say we are long or own that last buy signal, we are still invested. So it's been a rocky period. From on one hand, the buy signal was after some of the pullback. So the market vol is outperforming the S&P 500. The lev vol, which has leverage tacked on, a little deeper drawdown. In terms of the quant strategies known as sector alpha and sector alpha balanced, those strategies have us in more aggressive sectors, and they've been 2 steps forward, 1 step back throughout Q2. Again, starting to perform a little better here in early July. Let's move over to our thematic strategy. So we went over our core strategies. We went over our quant strategies. Our thematic strategies are US ETF, which focuses on industries and sectors that we feel can outperform in a longer term time horizon. A lot of innovation in that type of strategy. What's interesting is areas within US equity ETF that had really gotten beaten down over the last 12 months, and that was specifically alternative energy and biotech.
Or killed, but
have seen a nice lift, a very
absolutely.
Nice lift. So we'll see if that can continue into Q3. Tactical trend, a strategy that has a flexible mandate. It can be in US equity, international equity, fixed income, commodities, and cash. Right now, cash has been a strong performer in our relative strength work and is about 30% of the portfolio. It's joined by domestic equity here, and commodities have pulled back enough to be very interesting going into this third quarter. In terms of cash levels in tactical trend, normally they're anywhere from about 5% to 50%. So we're in a fairly heavy cash position, looking to see some of the markets just give a second and third buy signal, trying to see a higher bottom in some of these markets. And that's our Q2 wrap, Moose.
Done.
We hope you enjoyed this video and look forward to providing you with more review content on markets and Cumberland Advisors investment strategies on a quarterly basis. Feel free to reach out to us with any questions, and make sure to visit our YouTube channel where you can find other relevant content such as our Week in Review series or strategy profiles. Thank you.